Tom Lee is out with a new statement and a bold prediction for stocks. Tom Lee says you should buy the dip in stocks before next week's jobs report. Lee said the April core PCE data showed cooling inflation and that prior releases have been a tailwind for stock prices. Quote, we see high probability that stocks perform well into next week's May jobs report. Furthermore, Tom Lee said the slight decline in stocks over the past week presents investors with an attractive entry point, especially after the release of April core PCE data, which showed a cool down in inflation and ahead of the jobs report. Quote, this is the best core PCE month over month for all of 2024 and supportive of the notion that inflation pressures are abating. And Lee thinks future PCE reports will continue to show disinflation, which should boost the chances of Fed interest rate cuts later this year and support higher stock prices. Quote, we believe these improvements are sustainable. Housing is decelerating at a steady pace and converging on the market-based measures, which are not showing 6% year-over-year growth rates, Lee said. Core PCE excluding housing grew 0.22% month-over-month, down from 0.31% month-over-month in March, and the year-over-year has been dripping lower to 2.15% versus 2.19% year-over-year in March. So outside of housing, PCE inflation is on target. Tom Lee crunched the numbers and highlighted that since the end of 2022, stocks generally performed well following releases of the monthly core PCE reports, especially when stocks were down 1% in the 5 days before the release. Of the 4 PCE reports since the end of 2022 that included stocks falling 1% heading into the report, stocks were higher every time a week after the release of the PCE report by an average of 2.3%. Thus, we see a high probability that stocks perform well into next week's May jobs report. And next week's jobs report is on Friday, so there could be a window of opportunity here. Current estimates for this jobs report expect 175,000 jobs were added to the economy in May, with an unemployment rate stuck at 3.9%. Such a report would match the April jobs report and likely put some pressure on the Fed to cut interest rates sooner than later. But I actually wouldn't be surprised if we come in with a jobs number around 150,000 or so. And I actually wouldn't be surprised if it comes in around 130,000 jobs. That is because historically, when you start to see the labor market weaken, it can actually weaken pretty quickly. And before you do go into a recession, which I don't necessarily think that is happening right now, it's possible, but I don't think so. You actually see like jobs reports come in at 100,000 jobs and then 2,000 jobs. Like you see a drop off big time. Now, I'm not expecting that. And if we were to see some kind of off the cliff drop off, that would be seen as bad news and stocks would sell off on that. So that's not what I'm expecting, but to see a continued drop, I think should be the expectation. Now, judging off of what we've seen on Friday, let's just give a little bit of a recap. So what happened is the PCE report came out. Small caps, NASDAQ, S&P all did well following that initial release. You actually seen a gap up. But what happened is you started trading and some of your fears around AI started to come about, including Dell. Dell was down as much as 23% following their earnings that really threw some cold water on big tech as well as your AI trade. Now, that was one part of it, and I think that was the biggest part of the sell-off that you've seen on Friday. I don't think it was PCE that wasn't good enough that caused stocks to sell off. That's not what it was. PCE was great, and that's why stocks rallied into the end of the day. Markets can handle bad news. They can't handle uncertainty. So bad news was there. Dell did good, but not good enough to impress investors. We got over it because there wasn't uncertainty anymore. And that's why stocks rallied into the end of the day. But I also think the other side of what happened is as you get closer to the Fed actually cutting rates, who benefits from that? Small caps, interest rate sensitive stocks. Who does not benefit from the Fed lowering rates? Big tech. right? Meta, Amazon, Apple, Google, Microsoft, all of these stocks with, hundreds of billions of dollars in some cases of cash in the bank, like a Google, or, 50 billion, whatever the number is, a large amount. They're actually just collecting interest on that cash, and it goes straight to their bottom line. It's just easy money for these big tech names. As the Fed starts to cut rates, that easy money is gone, and you can actually make an argument that the Fed cutting rates is negative for big tech earnings. So in all actuality, I think you're going to start seeing a much wider and broader market rotation. Now, think about it like this. Big tech has been like the only thing that has worked. Certain parts of healthcare, sure, they have also worked. Utilities are starting to work a little bit better. But all of the money, a vast majority of the money that has went into markets in the past couple of years has concentrated into big tech. Now, as big tech starts to underperform other areas like small caps and interest rate sensitive stocks, what do you think is going to happen? Let's just throw it out there. What do you think is going to happen? Fund managers are going to start chasing other areas that are doing better, right? The first month that small cap outperforms big tech, and it looks like that will continue, big money will start to pull money out of big tech and start to put money into small cap stocks. I also think the other side of rate cuts that we don't talk about as much is recession, right? As the Fed starts to lower rates, the odds of a recession fall. The odds of a recession falling are also good for small caps, and it will give big money investors more confidence to actually go out and buy small cap stocks. That the Fed is now your friend and they're going to support the business cycle. And I think that's very powerful and does not get enough attention. Considering IWM is still off of its all-time highs of about 15%, I think there can be quite a run here. Now, if you consider the S&P and the NASDAQ are... it's kind of ridiculous. The NASDAQ, from its prior all-time highs, like the Russell back in late 2021, the NASDAQ is higher than that level by about 12%. So just to get a comparable move, you'd be looking at a 27% run in small caps. That could put IWM around the 260 level, just to compare to what's happened to the NASDAQ. And you could probably run even further from there, just considering the capitalization that is within small caps, meaning that big money is not allocated to small caps basically at all, as the really recession odds have been elevated as the Fed has kept rates higher for longer. That is a real reason to start buying small caps. And if you are a fund manager or a retail investor like yourself, likely watching this video, that is really where the vast majority of the gains are going to be, in small cap stocks. I think the S&P and the NASDAQ, at least on a headline basis, are more than fully valued. I mean, the NASDAQ and the S&P, they're not pricing in a recession. In fact, they're pricing in another 10% of earnings growth for 2025. Even if you achieve that, that would mean stocks are fairly valued today. Like, if you come in less than that, then stocks are expensive. If you come in higher than that, oh my gosh, you're going to be in a boom time economy. And I don't know if we should expect that either. But small caps, they're not priced for anything good. Modest growth in EPS. Whereas, in fact, in Q3 and Q4, that growth should really start to accelerate. So I think these are all reasons to own small caps. We're only trading at 11 times earnings, whereas the NASDAQ is closer to 30 times. And as Tom Lee talks about all of the time, there's about 6.4 trillion to be exact, of cash on the sidelines in money market funds alone, let alone cash in brokerage accounts, let alone cash in bank accounts that, people may deploy into markets. Overall, there's probably $8+ trillion of cash waiting to be invested in the markets. And I think a lot of that money could make its way into small cap stocks. So I don't think Tom Lee's 50% projection, 50% rally projection for small caps is too outrageous. I actually think following the PCE report that we got on Friday, it's probably likely that small caps could break out of their prior highs for 2024. This was on March 28th when IWM hit $211.88 and closed at about $210. I actually think you could probably get into the mid-teens, maybe 213, 214, 215 on IWM by the jobs report coming out next Friday. I mean, after all, you rallied almost 1% on IWM in regular trading, up another 0.33% in after hours. You're currently sitting at 206.45. This did break you out above your 20-day moving average. The next level of potential resistance is around 209. Call it around 210. You're probably going to get more resistance. That's probably a better resistance level to have marked here. And above that, I mean, small caps could really run. The last time you were above 210 on small caps was back here in very early 2022, and you, well, sold off big time around that level and never came back to it. So if you start to break out to a new multi-year high on small caps, yeah, that's going to attract a lot of investor attention. And I do think there is a very high likelihood that we get the first cut from the Fed coming July 31st, 2024. Expectations currently are nothing will happen on July 31st. There's an 83.8% chance of no cut July 31st and a almost 16% chance of your first cut coming July 31st. Now, I think as long as the inflation report comes out June 12th, good. Comes out around July 12th, good. And as long as the Fed doesn't throw cold water on the rally that we've seen in stocks so far on inflation, about the path of, the Fed cutting rates on June 12th, you could start to price in the first cut July 31st. And I think that could give a lot more room for stocks to run here. And again, notice how Wall Street is not currently expecting the first cut July 31st. If we start to expect the first cut, if it starts to get priced into markets, yeah, there's a lot of upside there. We also have ISM services data coming out next week and a couple other, bigger pieces of data as well. We'll talk about those more in the video coming out tomorrow. That is going to do it for this video. Let me know what you think about what Tom Lee said, as well as what I said here in this video. Do you think a rally is going to come for small caps? Or do you think Friday was kind of a one and done thing? Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.